Trading is the act of buying and selling financial assets, such as stocks, bonds, currencies, or commodities, with the aim of making a profit. Trading can be done through various platforms, including stock exchanges, forex markets, and online brokerages. Trading can be a lucrative way to earn money, but it requires discipline, knowledge, and risk management. Types of trading. There are several types of trading, each with its own set of strategies and risks. Stock trading. This involves buying and selling stocks listed on a stock exchange. Stock trading can be done through a brokerage account or a direct access trading platform. Forex trading. This involves buying and selling currencies in the foreign exchange market. Forex trading is usually done through an online brokerage platform. Options trading. This involves buying and selling options contracts, which give traders the right but not the obligation to buy or sell an underlying asset at a specific price within a specific time period. Futures trading. This involves buying and selling futures contracts, which are agreements to buy or sell an underlying asset at a specific price and date in the future. Trading strategies. There are many trading strategies that traders can use to achieve their investment goals. Some of the most common strategies include day trading. This involves buying and selling assets within the same trading day, with the aim of profiting from small price movements. Swing trading. This involves buying and holding assets for a few days to a few weeks, with the aim of profiting from medium-term price movements. Position trading. This involves buying and holding assets for a few months to a few years, with the aim of profiting from long-term price movements. Trend following. This involves identifying the direction of the market trend and buying or selling assets accordingly. Risk management. Trading involves significant risks, and it's important for traders to manage their risk carefully. Some of the most common risk management techniques include setting stop-loss orders. This involves setting a limit on the amount of money that can be lost on a trade. Diversifying the portfolio. This involves investing in different assets to spread the risk. Using leverage cautiously. This involves using borrowed funds to increase the size of the trade, but it can also increase the risk of loss. Staying disciplined. This involves sticking to a trading plan and avoiding emotional decisions. Conclusion. Trading can be a lucrative way to earn money, but it requires discipline, knowledge, and risk management. Traders should carefully consider their investment goals and risk tolerance before entering the market, and should consult with a financial advisor if needed. With the right strategy and risk management techniques, trading can be a rewarding and profitable activity.